Welcome back. This is part 5 of the series dedicated for beginners to find undervalued stocks. So you have been shortlisting companies, you had a big list, you drilled it down, reduced the size of the list, and now say you have 30 stocks to look at. As I mentioned earlier, you don't want to have 30 stocks. That's too much to track and maintain. So we want to have something around 10 to 15, not more than 15. That should be enough diversification. A stock portfolio with 10 to 15 stocks is enough diversification. Beyond that, it doesn't help. Law of diminishing returns. So take the companies that you really understand well. And then think about it as if you will buy the entire company. If given a choice, will you buy the entire company? And project the earnings in future. To give an example, if they are making 10 rupees earnings per share, if they earn 10 rupees today, and if you feel in the future they will be earning 25 rupees, I will tell you how to get this figure in a later video, but now let's assume that you know that from 10 rupees they will be able to earn 25 rupees in the future. That is your projection. That is based on your story. That is based on your insights. Now, since you know that they will be earning 25 rupees, think about it as if you will buy the entire business. Let's assume a business makes 10 lakhs a year. Will you buy the company for 10 lakhs? Will someone sell it for 10 lakhs? Because in 1 year you will get it. You'll be very happy to get that in 1 year. Put the cost of capital at 10%. Still, you will be able to get the money that you had put into the business. Very easy. So usually, you will have to pay some multiples. Your payback period. This is called payback period. How much time it takes to get back your initial investment. Although not accurate, there are other figures using time value of money. Those are not for this session. As a beginner, we need to keep everything very simple. Keeping things simple makes a lot of difference. And today we will use payback period, which means how much time would you take to get back the money? If you feel you will get back the money in 100 years, that's too much risk. You don't want that company right now. As a beginner, we don't want to take that risk. We need to look at other options, other opportunities, because a company that takes too long to get back your returns means there are too many variables. Those are for intermediate and expert investors, which we will avoid right now. Because it doesn't mean taking too much risk means too much returns. There are situations when you can take lesser risk and still get enough returns. So let's come back to the discussion on how much would you pay. So you said they would be able to get 25 rupees in the future. So that means, let's say you feel that the company is a stable company, and based on how stable it is, you value it between 125 and 500 rupees. You can pay 125 to 500 rupees in the future to buy that company. If you are very confident, you can say 500. If you're not so confident, you can stick with 125. It depends on how confident you are that the earnings will really be attained in the future, and how confident you are with the entire industry, with the macroeconomics of it, and all those information that you gather to attain this valuation. We will look at those information in the next video, but for now, let's say that you figure out a value something between 125 and 500. Now, the 500 rupees price is for the future. We need to bring that to today's value. 500 rupees tomorrow is not 500 rupees today, because if you invest 500 rupees today, you get some interest in the form of risk-free return. If you put it in a fixed deposit, you would get some money out of it. So a future value of 500 is something else today, lesser value today. We need to figure out how much it is. So to take the same example, 500 rupees future value, let's say you demand 13% returns for this company. We will talk about how to arrive at this value 13, but for now, let's assume that you have calculated it as 13%, which is risk-free rate from risk premium that you will charge. You have a certain risk premium for the stock and you have a risk-free return, that is your fixed deposit, and you add both of these, you get this value 13%. This will be an assumption for this example. Let's assume your future period is 10 years. So fire up your Excel sheet or Google sheet and type in PV, that is present value, put an equal to sign before, and then put PV, open a bracket, and give these values. 13, that is your interest rate. 10, that's the number of years. 0, that is the payment. You won't make any payment here, so let's forget that, it's just 0. And then minus 500. Future value is 500. You need to put a minus sign because it's future value. You need to bring it back to today's value and compute the value. So that is 147. If you feel you need to add some more cushion to this, if you're not so confident, you can say that you want to have 10% margin of safety on top of this. You can do that, but this is your story and this is your value. You need to make sure you took all the care to arrive at it. Make sure you look at the previous parts and the other parts that follow this video to understand how you can figure out all these numbers and put it into your valuation model. This is very easy. All it takes is less than an hour. You won't take more than an hour to do a valuation for the first time. After that, it's going to take less than 5 minutes for you to compute valuation for any company, as long as you understand the entire company and put in the right numbers. You might take some time to understand the company, but that's going to be easy because you already are a consumer of that product and you know better than anyone else. So make sure you subscribe to my channel and don't forget to look at the other parts that follow this video.